Welcome to another episode of 51 Insights, this week with our Friday newsletter. This is Mark. The SEC and CFTC just issued a joint 68-page interpretation that gives crypto a clearer regulatory map. The SEC approved Nasdaq's plan to trade tokenized securities. Mastercard paid $1.8 billion for a stablecoin infrastructure company, and HSBC and Standard Chartered are about to receive Hong Kong's first stablecoin licenses. This is one of the biggest weeks in crypto regulation we've seen. Let me walk you through it. So let's start with the SEC. Three big moves happened this week, and together they're a breakthrough in crypto regulation. First, the SEC and CFTC issued a joint 68-page interpretive release on March 17th. It lays out a 5-part token taxonomy: digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. The release treats protocol staking, mining, and airdrops as non-securities activities when they don't involve a separate investment contract. Second, the same day, SEC Chairman Paul Atkins previewed something called Regulation Crypto Assets, a forthcoming safe harbor proposal that will give early-stage token projects up to 4 years and $5 million in capital formation without full SEC registration. And third, Director Monali declared the end of the Howey test for crypto, the 80-year-old standard used to classify tokens as securities. She's proposing a tailored registration path for digital assets instead. So what does this all actually mean? The Howey test now has an expiration date. The SEC formally recognizes that investment contracts can terminate, and a token does not remain a security forever once the network reaches maturity. That clears the path for DeFi protocols and VC funds that previously had no clean exit to secondary distribution. Every compliance team that blocked institutional exposure to crypto on securities grounds now has to update the memo. We also spoke with the SEC Commissioner Hester Peirce about crypto's new rules, and she had some surprising things to say. She actually apologized. Link to that interview is in the description. Now, the infrastructure response is already visible, which brings us to the next story. The SEC on March 18th approved Nasdaq's rule change to let market participants settle trades in Russell 1000 stocks and ETFs tracking the S&P 500 and Nasdaq 100 as blockchain-based tokens. Settlement runs through the DTC's tokenization pilot that received a no-action relief back on December 11th, 2025. Tokenized shares trade on the same order book as traditional shares, same ticker, same CUSIP. Holders keep the same voting rights, dividends, and execution priority. First token-settled trades are expected Q3 2026 at the earliest. And here's what's interesting about Nasdaq's approach. They're keeping tokenized and traditional shares on the same order book. That preserves their deepest competitive asset, which is existing liquidity depth. No fragmentation risk, no price dislocation. In contrast, New York Stock Exchange is taking the opposite bet, building a separate 24/7 venue with instant settlement and stablecoin funding. Both exchanges are now racing through crypto-native partners, and New York Stock Exchange via OKX 120 million accounts and global distribution. The race is which exchange crypto pair reaches production-ready 24/7 global equity flow first. And Nasdaq holds US regulatory clearance right now. We break down the full Nasdaq versus New York Stock Exchange comparison in this week's CEO Notes. If you want to understand where this is headed and what it means for your institution, that's in the pro briefing. Link in the description below. All right, moving to Hong Kong. HSBC and the joint venture between Standard Chartered and Imoca Brands and Hong Kong Telecommunications are expected to receive Hong Kong's first stablecoin issuer license as early as March 24th. These fall under Hong Kong's Stablecoin Ordinance, which took effect in August 2025 and requires all fiat-referenced stablecoin issuers to get HKMA approval, hold one-to-one high-quality liquid assets reserves, and offer redemption at face value within 1 business day. The HKMA is prioritizing institutions already authorized to issue physical banknotes. And the context here matters. Beijing effectively banned onshore RWA tokenization on February 6th through an 8-agency joint notice that classified it as illegal financial activity. Hong Kong responded by accelerating its own stablecoin framework and handing the first licenses to the same institutions that already print the city's physical banknotes. This is not fintech licensing. This is monetary policy architecture. The HQDs pegged to the dollar means HSBC and Standard Chartered now issue what is in effect a dollar proxy with Chinese distribution rails, one-to-one reserves, and HKMA oversight. Next, and this one is also a big story of this week, Mastercard agreed to acquire BVNK, a UK-based stablecoin infrastructure company processing 30 billion in analyzed volume across 130 plus countries for up to $1.8 billion. 300 million of that is contingent on performance milestones. The deal is 2.4 times BVNK's 750 million Series B valuation from December 2024. And here's the crazy thing about this story. Coinbase entered exclusivity at roughly $2 billion in late 2025 and walked away. For the past 18 months, Mastercard has been steadily building its stablecoin presence, partnering with MoonPay, SoFi, Fiserv, and Chainlink, and launching an 85-company crypto partner program in March 2026, just about 2 weeks ago. Now look at the trajectory. Stripe paid $1.1 billion for Bridge in February 2025. MoonPay paid over $100 million for Iron a month later. Mastercard just paid $1.8 billion for BVNK. Every transaction price is straight. So the math here is pretty simple. Whoever controls the fiat to stablecoin conversion layer at enterprise scale owns the toll booth on a corridor where stablecoin transfers on public blockchains hit 27 trillion in 2024. That's more than Visa and Mastercard combines annual card volume. The card networks are not competing in stablecoins. They are acquiring their way into the new rails before they get disintermediated. Speaking of which, PayPal made its dollar-backed stablecoin PYUSD available across 70 markets in a single release, adding 68 countries after operating exclusively in the US and UK since the token launched in August 2023. The first wave skews towards remittance-heavy corridors. Users earn 4% annually in the US on holdings and can convert to local currency on withdrawal. Its market cap has grown from under 500 million in early 2025 to roughly 4.1 billion. Most stablecoin issuers have the token, but not the distribution. PayPal has both. 439 million active accounts, 35 million merchants, and 70 countries switched on in one go. So the cool thing here is that while cross-border fees still average about 6.5% worldwide, PayPal made it free to send dollars to any PayPal wallet. And then there's Stripe. On March 18th, Stripe and Tempo co-released the Machine Payment Protocol, an open spec that lets AI agents request, authorize, and settle payments in milliseconds without human approval at checkout. Tempo's mainnet, backed by $500 million from Paradigm and Thrive Capital at a $5 billion valuation, settles the stablecoin leg with sub-second finality at 100,000 plus transactions per second. The protocol accepts both stablecoins and fiat through a single integration, with Visa, Mastercard, OpenAI, Anthropic, and Shopify all listed as design partners. Most agent payment protocols pick a lane. Coinbase's X4012 is crypto native. Mastercard's Agent Pay is card native. Stripe is the only company right now that covers both rails, plus merchant base, AI protocol, Web3 interface through Privy, AI billing through Metronome, Trust Bank Charter through Bridge, and blockchain through Tempo. It's Stripe's bid to become the default financial infrastructure for the agent economy, the same way it became the default for human e-commerce. Also worth noting, Morgan Stanley filed an amended S1 for a spot Bitcoin ETF on New York Stock Exchange ARCA. And Flow Traders launched a 24/7 OTC desk for tokenized assets, including Franklin Templeton's Benji and Tether Gold. Figure also launched private credit infrastructure on-chain with Apollo and Pantera, and ICE, the parent company of New York Stock Exchange, launched a private credit intelligence platform with Apollo as anchor partner. All right, let me run through the news flash, quick hits. While US lawmakers are negotiating the Digital Asset Market Clarity Act, Senator Loomis is signaling compromise on the crypto market structure bill. Coinbase tokenized its Bitcoin yield fund on Base with Apex Group. S&P licensed the S&P 500 to trade XYZ for perpetual contracts on Hyperliquid. Anchorage Digital launched institutional collateral management on its Atlas network. Vietnam will license domestic crypto exchanges and block offshore platforms. Signum Bank, the Swiss crypto company's off-exchange custody, surpassed $1 billion in assets. Layer 0 and Centrifuge partnered for omni-chain RWA distribution. Ironlight raises a 21 million Series A for tokenized securities infrastructure. And as always, if you want the full analysis on any of these topics, that's what the Pro Briefing is for. CEO notes drop on Monday and then every weekday with alpha insights and the deeper positioning analysis. If you're building infrastructure, allocating capital, or pricing the shift to always-on markets, that's the briefing your competitors are already reading. Link to subscribe in the description. That's it for this week. Thanks for tuning in. See you next time.